January 9th, 2026. While the Western world slept, something happened in Shanghai that the financial establishment prayed you would never witness. 64 tons of silver were requested for delivery. Standard procedure, nothing extraordinary. The vault doors opened, and what emerged? 1 ton, not 64. 1, a 98.5% failure rate. At the world's largest physical silver exchange, this isn't a shortage, gentlemen. This is a default. And if Shanghai, with all of China's refining power, cannot deliver, what happens when New York gets the call? Welcome to Currency Spot. If you've made it this far in life, built something, protected something, perhaps weathered a few financial storms along the way, then you understand that information like this doesn't come with a warning label from your broker. We'd be honored if you'd subscribe to this channel, not because we need the numbers, but because men and women of experience deserve a place where economic reality isn't sugar-coated for mass consumption. And before we continue, tell us in the comments, where in the world are you watching this from? Because what happened in Shanghai on January 9th is coming to a market near you. Let's begin. On the morning of January 10th, 2026, a veteran commodities trader in Singapore opened his settlement report from the Shanghai Gold Exchange, and what he saw made his coffee go cold. The numbers on the screen didn't make sense, not because they were complicated, but because they were impossible. He had requested delivery of 3 tons of physical silver the day before. Standard business. Nothing unusual. He had done this same transaction hundreds of times over his 30-year career. The exchange had always delivered, always, until Thursday, January 9th. His delivery allocation, 47 kilograms, out of 3,000 kilograms requested, a 98.4% shortfall. He immediately called his counterparty in Shanghai. The response he received was carefully worded. Logistical delays due to settlement processing complications. But this trader had been in the business long enough to know what those words actually meant. They meant the metal wasn't there. What this trader didn't know yet was that he wasn't alone. Across Asia, Europe, and North America, dozens of institutional buyers were staring at similar reports, all requesting physical silver, all receiving virtually nothing. The Shanghai Gold Exchange had received delivery requests totaling 64 metric tons of physical silver that day. To put that in perspective, 64 tons equals approximately 2.58 million troy ounces. Not a small amount, but also not extraordinary for the world's largest physical precious metals exchange. In a functioning market, that request should have been processed without difficulty. The exchange had handled larger volumes before, many times, but on January 9th, something was different. The vaults delivered only 1 metric ton, approximately 32,000 troy ounces, against a demand of 2.5 million ounces. The mathematics were brutal. For every 100 ounces requested, buyers received 1.5 ounces. 98.5 ounces simply vanished. Now, a reasonable person might ask, where did the silver go? The answer is more disturbing than the question. It didn't go anywhere, because it was never there in the first place. The Shanghai Gold Exchange operates differently from Western futures markets. In New York or London, most traders never intend to take physical delivery. They trade contracts, paper promises. Cash settlement is the norm. But Shanghai built its reputation on physical delivery, real metal, real vaults, real settlement. That's why China's industrial consumers trusted the exchange. That's why international investors paid premiums to access it. The physical delivery guarantee was the entire foundation of the market's credibility. And on January 9th, that foundation cracked. What made this event particularly significant was the timing. This wasn't during a crisis. There was no market panic, no sudden surge in demand, no extraordinary circumstances. This was a routine settlement day, standard monthly contract expiration, business as usual, except the usual didn't happen. The exchange issued a brief statement, carefully crafted, precisely worded. They called it a temporary settlement delay due to logistics coordination. They did not use the words force majeure. They did not acknowledge a delivery failure. They did not admit the metal was unavailable. But the numbers told a different story. And numbers don't negotiate. They don't spin. They don't issue diplomatic statements. A 98.5% delivery failure is not a logistics issue. It's a default. Within hours, the physical silver market began responding, not with panic, but with recognition. In Shanghai, physical silver premiums jumped to $12 per ounce above the COMEX spot price. Normally, that spread runs between 50 cents and $1.50. The premium expansion wasn't speculation. It was market participants pricing in a new reality, the reality that paper prices and physical availability had officially divorced. In London, several major bullion dealers quietly updated their delivery timelines, from 2 weeks to 8 weeks, then from 8 weeks to subject to availability. In New York, 3 institutional precious metals funds requested emergency meetings with their custodians, asking one simple question: can you verify physical allocation of our silver holdings? The responses were evasive. Meanwhile, the mainstream financial media remained largely silent. A few brief mentions buried in commodities sections. No headlines, no analysis, no investigation, because the implications of this event were too dangerous to examine publicly. If Shanghai cannot deliver 64 tons of silver, with all of China's mining output, with all of China's refining capacity, with direct access to the world's largest silver supply chains, then what happens when the pressure shifts to Western exchanges? The COMEX in New York holds approximately 30 million ounces in registered inventory, available for immediate delivery, but the open interest in COMEX silver futures represents claims on more than 600 million ounces, a 20-to-1 ratio, 20 paper claims for every physical ounce. The system works perfectly, as long as everyone doesn't ask for delivery at the same time. And until January 9th, 2026, no one believed that day would ever come. Shanghai just proved otherwise. There's a game that Wall Street has been playing for decades, and most people don't even know they're part of it. It's called fractional reserve commodities trading, and it works beautifully until it doesn't. Let me tell you about a pension fund manager in Frankfurt. We'll call him Heinrich. Heinrich managed 4.2 billion euros in assets, conservative portfolio, blue chip stocks, government bonds, and a 3% allocation to precious metals for inflation protection, standard practice. His silver position was held through a reputable ETF, exchange-traded fund, backed by physical metal, or so the prospectus claimed. Heinrich had never questioned it. Why would he? The fund had an AOA rating, audited annually, regulated by financial authorities. On his quarterly statements, the numbers showed he owned 2.8 million ounces of silver. Clean, simple, secure, or so he thought. After the Shanghai delivery failure on January 9th, Heinrich did something he had never done before. He actually read the full ETF prospectus, not the summary, not the highlights, the actual legal document, buried on page 47, in section 12.3, subsection D. He found 7 words that changed everything. Physical delivery is not guaranteed under all circumstances. He read it again. Then he called the fund's custodian bank. The conversation was polite, professional, carefully scripted. Mr. Heinrich, your position is fully backed by physical silver holdings. Can I take delivery? He asked. A pause. Well, the fund operates on an unallocated pooled basis. What does that mean? Heinrich pressed. Another pause. It means your silver is part of a collective holding. We don't assign specific bars to specific investors. But if I wanted to redeem my shares for physical metal? The longest pause yet. That would require special arrangements, minimum quantities, additional fees, and current delivery timelines are extended. Heinrich understood perfectly. His 2.8 million ounces of silver existed on paper, but in reality, he owned a promise, a very expensive promise. This is how the modern precious metals market actually functions. It's not a conspiracy, it's not illegal, it's just structured. Let's talk about the COMEX, the Chicago Mercantile Exchange, the place where silver prices are supposedly discovered, where the market determines what silver is worth. At any given time, the COMEX has roughly 30 million ounces of silver sitting in registered vaults. Registered means available for delivery, actual physical metal that can be withdrawn. 30 million ounces sounds like a lot, until you look at the other number, the open interest. Open interest represents all the active futures contracts. Each contract is a claim on 5,000 ounces of silver. And there are currently contracts representing more than 600 million ounces. 600 million ounces of paper claims, 30 million ounces of actual metal, a ratio of 20-to-1, 20 promises for every physical ounce. Now, the system's defenders will tell you this is perfectly normal. They'll say that most traders never take delivery. They just want price exposure. They cash settle. And that's true. 98% of futures contracts settle in cash. The system is designed that way, encouraged that way, incentivized that way. Because if even 15% of contract holders demanded physical delivery simultaneously, the entire structure would collapse. Not might collapse, would collapse, mathematically, inevitably, immediately. This isn't speculation, it's arithmetic. But here's where it gets more interesting. The COMEX silver market doesn't exist in isolation. It's connected to a global derivatives network. Banks, hedge funds, mining companies, industrial consumers, all trading silver in various forms, futures, options, swaps, forwards. The total notional value of silver derivatives globally, estimated at over $200 billion, The total value of physically deliverable silver across all exchanges worldwide? Approximately $30 billion. That's a leverage ratio of nearly 7 to 1. $7 of paper claims for every dollar of physical metal, and that's being conservative. Some analysts put the real ratio closer to 15 to 1. But let's stick with 7 to 1, because even at 7 to 1, the mathematics become absurd. Global silver mine production runs about 830 million ounces annually. Industrial consumption absorbs 520 million ounces of that, leaving 310 million ounces for investment and monetary demand. Now, if just 30% of silver derivative holders decided they wanted physical settlement, that would require $60 billion worth of silver. At current prices, that's roughly 800 million ounces. Where does that silver come from? It would take nearly 3 years of total global production, assuming zero industrial consumption, which is impossible, because industrial users need silver for solar panels, electronics, medical equipment. They can't just stop. This is the illusion. The paper market creates the appearance of abundant supply. Prices stay stable, or even decline. Because paper is infinite, you can create another futures contract with a keystroke, but physical silver requires mining, refining, transportation, storage. Physical silver is finite. And on January 9th, 2026, Shanghai reminded the world of that difference. When the vault doors opened and revealed the truth, paper promises and physical reality had finally diverged. And once that divergence begins, once traders start questioning whether their paper actually represents metal, once the scramble for physical allocation starts, the leverage pyramid doesn't unwind gradually, it collapses suddenly. Because fractional reserve systems have one fatal flaw. They depend entirely on confidence. And confidence, once broken, doesn't repair itself, it shatters completely. Heinrich in Frankfurt understood this now. His 2.8 million ounces weren't really his. They were a percentage of a pool that was probably leveraged, against other pools that were also leveraged, in a chain that ultimately led back to vaults that might not contain what everyone thought they contained. And he wasn't alone in this realization. Across the global financial system, thousands of institutional investors were having the same awakening. The Shanghai delivery failure was a warning shot, not from China, but from reality itself. There's an old Chinese proverb: when the wind changes direction, some build walls while others build windmills. On December 3rd, 2024, Beijing made a decision that most Western analysts dismissed as routine trade policy. Export restrictions on antimony, gallium, and germanium, technical metals, obscure elements, nothing that would make headlines. The financial media barely noticed. 6 weeks later, rare earth export licensing requirements were expanded. Again, minimal coverage. A few trade publications mentioned it. Most investors ignored it. Then came January 9th, 2026. And suddenly, those seemingly unrelated decisions formed a pattern that a commodities strategist in Hong Kong had been tracking quietly. Let's call her Lin. Lin had spent 15 years analyzing China's resource policy. She understood something that most Western traders didn't. Beijing doesn't make announcements. Beijing creates conditions. And those conditions take months, sometimes years, to fully materialize. On the morning of January 10th, Lin pulled up 3 data points on her screens. First data point: COMEX silver spot price, $74 per troy ounce. Second data point: Shanghai Gold Exchange physical silver premium, $82 to $86 per ounce. Third data point: the spread between them, $8 to $12 per ounce. In normal markets, that spread runs 50 cents, maybe $1.50. A $10 premium represents a 13.5% price differential. That's not a premium. That's a chasm. And in commodity markets, chasms don't persist. Because arbitrage exists, traders buy cheap in New York, ship to Shanghai, sell at premium, pocket the difference, risk-free profit. That arbitrage should collapse the spread within hours, except it wasn't happening. The spread was widening, not narrowing. Lin knew what that meant. The silver physically couldn't move. Either it was legally prohibited, or it was physically unavailable, or both. She opened another screen, Executive Order 1.346, signed by the U.S. administration, creating a tariff framework for strategic materials. The interesting part wasn't the tariffs themselves, it was Annex 2. Annex 2 provided exemptions for precious metals bullion. Legal channels remained open, at least on paper, but legal channels mean nothing if the metal doesn't exist to flow through them. Lin had been watching China's silver positioning for 3 years. The pattern was unmistakable. It was identical to what China had done with gold between 2018 and 2022. Silent accumulation, domestic production redirection, export throttling, not through dramatic announcements, but through quiet, systematic policy adjustments. Consider the numbers. China produces approximately 3,600 metric tons of mined silver annually. That's roughly 115 million troy ounces. About 18% of total global production. Not the largest producer, but close. Mexico produces more. Peru produces more. But here's what makes China different. China also refines 35% of the world's silver supply. Mexican ore gets shipped to Chinese refineries. Peruvian concentrates get processed in Chinese facilities. Australian mining output gets refined in China. So while China only mines 18% of global supply, Chinese facilities touch 35% of all silver that enters the market. That creates leverage, enormous leverage, because refining capacity can't be relocated quickly. Building a modern silver refinery takes 18 to 24 months minimum. Environmental permitting, equipment installation, technical expertise. It's not something you can move to Vietnam or India overnight. Lin pulled up China's silver import data. 2023. China imported 4,200 metric tons of silver. 2024, imports dropped to 3,100 metric tons. 2025, imports fell to 1,800 metric tons, a 57% decline in 2 years. Meanwhile, China's industrial silver consumption was rising. Electric vehicles, solar panels, 5G infrastructure, all silver-intensive technologies, all expanding rapidly. Chinese EV production alone consumed an estimated 85 million ounces of silver in 2025. Solar panel manufacturing, another 95 million ounces. So China's industrial demand was increasing, but imports were decreasing. That meant domestic production was being redirected away from export markets toward domestic consumption. This wasn't happening by accident. It was policy, deliberate, strategic, calibrated. Then Lin looked at the timeline again. December 2024, antimony export controls announced. January 2025, rare earth licensing expanded. January 9th, 2026, Shanghai delivery failure. 12 months of systematic preparation, and the Western financial system had missed it entirely because they were watching the wrong indicators. They were watching Chinese official statements, press releases, ministry announcements, but Lin was watching the metal flows, the actual physical movement of materials, and the flows had been reversing for 2 years. She pulled up one more document, People's Bank of China gold reserve data. Official gold holdings had increased 25% between January 2023 and December 2024, from 2,068 metric tons to 2,587 metric tons, a massive accumulation conducted quietly, methodically, month after month. Now, silver accumulation doesn't get reported officially. Silver isn't a reserve asset by international standards. Central banks don't publish silver holdings. But Lin noticed something. The pattern of China's silver market behavior was tracking its gold accumulation. With an 18-month lag, gold accumulation started accelerating in early 2023. Silver export restrictions started tightening in late 2024. The lag made sense. Gold was the priority, monetary metal, reserve asset, international recognition. Silver came second, industrial metal first, monetary metal second, but still strategic, still finite, still controlled. What the West didn't understand, and what Lin had learned from watching Beijing for 15 years, was that China thinks in decades, not quarters, not election cycles, decades. When China restricts antimony exports, they're not thinking about this year's revenue. They're thinking about 2035's battery supply chains. When China tightens rare earth licensing, they're not concerned about current prices. They're positioning for the next generation of technology. And when Shanghai fails to deliver 64 tons of silver, that's not a logistics problem. That's a message. A message to every industrial consumer worldwide. A message to every defense contractor, every solar manufacturer, every electronics company. The message was simple. Physical silver is no longer a globally available commodity. It's a strategically controlled resource. And the terms of access just changed. The Shanghai COMEX price spread told the whole story. $74 in New York, where paper trades. $86 in Shanghai, where physical settles. The $12 gap wasn't a premium. It was the price of reality. And that reality was this. China had spent 2 years quietly repositioning itself. While Western markets traded paper promises, China secured physical metal. While Western investors chased futures contracts, China locked down refining capacity. While Western analysts debated Fed policy, China rewired the global supply chain. And on January 9th, 2026, the repositioning became visible, not through an announcement, but through absence. The absence of 63 tons of silver that were requested but never delivered. Lin closed her screens. She had seen enough. The wind had changed direction, and China had built its windmill. While the West was still arguing about which wall to build, there's a moment in every financial crisis, a specific point in time where the rules change, and most people don't realize it until it's too late. Let me tell you about David. David ran a mid-sized manufacturing company in Ohio. 47 employees, $22 million in annual revenue, good business, stable, profitable. His company produced specialized electrical components. Components that required silver, about 12,000 ounces per quarter. For 15 years, David had never worried about silver supply. He'd order from his supplier. Price would fluctuate, sometimes up, sometimes down, but the metal always arrived. Always. On January 13th, 2026, 4 days after Shanghai, David received an email from his primary silver supplier. Subject line, important update regarding delivery terms. He opened it. The message was professionally written, carefully worded, but the content was stark. Due to current market conditions, delivery timelines have been extended from 2 weeks to 12 within 16 weeks. Additionally, all orders now require 100% prepayment. Prices are subject to daily adjustment until payment is received. David read it twice. Then he called his supplier. The conversation was brief. What's going on? David asked. Market conditions, came the reply. What market conditions? Supply constraints from primary refiners. Which refiners? A pause. Several facilities in Asia have reduced export allocations. David understood. This wasn't about his supplier. This was about the entire supply chain restructuring in real time. He did some quick mathematics. His company needed 12,000 ounces per quarter, 48,000 ounces per year. At current spot prices, around $75 per ounce. That's $3.6 million annually. But now his supplier wanted 100% prepayment for a 16-week delivery window. That meant David needed to tie up $1.44 million in working capital, just sitting there, waiting for metal that might or might not arrive on schedule. And if prices jumped during that 16-week window, his cost could explode. No contract protection, no price lock, no guarantees. This was the new reality for businesses, for investors, for anyone who actually needed physical silver. The paper market still functioned perfectly. You could buy a futures contract with a phone call, trade options online, invest in ETFs with a single click. But physical metal, that had become complicated. Let's talk about what actually happens when paper and physical markets diverge, because most people don't understand the mechanics. They think there's one silver market. There isn't. There are two completely different systems. The paper system runs on leverage and liquidity. Prices are discovered through futures trading. Settlement happens in cash 98% of the time. Regulations are clear. Counterparties are known. The system is efficient, frictionless, fast. The physical system runs on metal and trust. Prices are negotiated with premiums. Settlement requires actual delivery. Timelines are measured in weeks. Storage is required. Transportation is complex. The system is slow, expensive, physical. For decades, these two systems coexisted peacefully. The paper price would guide the physical premium, usually within 2 to 3% of each other, and the connection was maintained through arbitrage. If physical premiums got too high, traders would buy paper, take delivery, sell physical. If paper got too cheap, physical holders would deliver into futures contracts. The mechanism kept things balanced until Shanghai. Now the arbitrage was broken, not bent. Broken? You couldn't buy paper in New York and get physical in Shanghai because Shanghai wasn't delivering. You couldn't buy physical in London and deliver into COMEX because the timeline and premium structure made it uneconomical. The two markets were separating, and when markets separate, investors face a choice that most aren't prepared to make because it requires answering one fundamental question. What do you actually own? If you hold shares in a silver ETF, you own a legal claim on a percentage of a pool. That pool may be backed by physical metal, or it may be backed by futures contracts, or it may be backed by swap agreements with banks. The prospectus will tell you, if you read page 47, subsection D, if you own futures contracts, you own the right to settle in cash or demand delivery. But delivery requires meeting specific conditions, minimum quantities, approved storage facilities, quality certifications. Most retail investors can't meet those conditions. If you own physical silver in allocated storage, you own specific bars with serial numbers. Those bars are segregated in your name. You can request delivery, but you'll pay storage fees, insurance, and transportation costs. If you own physical silver in unallocated storage, you own a general entitlement to silver, not specific bars. The facility can lend your silver to other parties. This is called rehypothecation. Your metal might be claimed by multiple parties simultaneously. The Shanghai delivery failure exposed this structure because when 64 tons were requested and only 1 ton was delivered, It meant 63 tons of silver existed on multiple balance sheets. Multiple parties believed they owned it, but it only physically existed once. Or in this case, it didn't exist at all. This is why David in Ohio was now facing prepayment requirements. His supplier couldn't guarantee metal availability because their supplier couldn't guarantee refinery output, because Chinese refineries were prioritizing domestic allocation. The chain of assumptions had broken. So what does a rational person do in this environment? The answer depends on objectives. If you're trading for profit, paper markets still work fine. You can speculate on price movements, use leverage, move in and out quickly. Just understand you're trading contracts, not metal. If you're hedging industrial consumption like David, you need to fundamentally rethink procurement strategy, increase inventory levels, accept longer lead times, build strategic stockpiles, diversify supplier networks, budget for premium expansion. If you're preserving wealth, that's where the real decision comes. Traditional portfolio theory says hold 5 to 10% in precious metals for inflation protection, for crisis hedging, for monetary insurance. But that theory was built on the assumption of liquid, functioning markets. Shanghai just invalidated that assumption. So the question becomes, do you want price exposure or physical possession? Because those are now different things. Price exposure is easy. Buy an ETF, own futures, trade options. You'll track the paper price perfectly. Physical possession is harder. Verify dealer inventory before payment. Understand premium structures. Arrange secure storage. Accept delivery timelines of 6 to 12 weeks. Pay 15-25% premiums over spot. But here's what physical possession gives you. Certainty. When you hold a silver bar with a serial number in allocated storage or in your own possession, you know it exists. You know it's real. You know no one else has a claim on it. That certainty has value. And as markets become uncertain,